Welcome to the Money Marketing Podcast in association with M&G. Estate planning used to be treated as a late life bolt-on conversation, but recent legislative shifts have brought it squarely into the mainstream financial advice. I'm joined today by Les Cameron, head of the technical team at M&G, to discuss why estate planning is not about death, but about making smarter choices while alive. Welcome, Les, and thank you for joining me today.
Hello, thanks for having me.
So, Les, as I said in the intro, the legislative landscape has shifted dramatically, particularly regarding the IHT treatment of pensions. What are the immediate planning red flags that advisors need to address right now for clients who thought their pensions were safe from the taxman?
Yeah, I think there is a number of red flags, and I think it depends on where you currently are in the estate planning journey. I think the immediate one that springs to mind is if you have clients and you've already actively made a decision, I'm not spending my pension because that's good to pass on. That plan doesn't work anymore, obviously, so you'll need to come up with a plan B there. I think the next set of people, they may be actively spending their other wealth to meet their retirement needs, leaving their pension to last. That old sort of rule of thumb might not be as effective as it used to be before. I suspect for a lot of people, consuming your pension on your retirement needs and giving away non-pension assets might turn out to be the most robust solution. And I think the third one is there'll be people where, your house and your pension is probably the two biggest assets you have. So I think the third group of people are the people that are going to get dragged into the IHT net that have never been there before. And they'll possibly be the hardest set of people to deal with because they might not have a plan in place currently. So they're currently planless when they need to start thinking about how to maximise the amount of money that goes to the next generation.
And you've often said that estate planning isn't about death. It's about decisions made while alive. So how does an advisor reframe this conversation for a client who's hesitant to discuss legacy planning?
Yeah, it's a hard one. I think, if you die without having taken any actions, then you've not really done any estate planning, have you? So estate planning is about the actions you take whilst you're alive, to make sure what happens, what you would like to happen when you die actually comes true. So I think that's one of the most important things. It's about not talking about death, your death, and it's not talking about tax. It's about trying to bring it, I think, reframing it as current actions, things you should or shouldn't be doing now, and how what you do and do not do now will affect people. As simple as people that aren't doing anything have actually made a decision. They've made a decision to maximise the amount of tax they're going to pay, minimise the amount that goes to their loved ones. They've kind of made a decision that their money might not go to the place they expect it to go, just because by doing nothing. So I think possibly reframing it in actions now. We're not talking about your death in 5 years' time or 10 years' time, 15 years' time. We're talking about the actions you can take now to make sure your money goes where you want it to go at a time you go, because ultimately the more tax you pay, the less money your family gets. So you have to make an active decision of how much tax you want to pay and when you want your family to get money, because it might be about giving them money now while you're alive, or it might be about giving them money after you pass away, or it could be a mixture of both. So I think you need to reframe it away from talking about tax and you dying into actions that you should be doing now. And no action does have an estate planning impact on you. The money might not go to the right people at the right time with the right amount of tax. So reframing that and what other decisions could we make? Because some people will have already made estate planning decisions. If they've written a nomination form for their pension, they have actually started actively thinking about their death because they're telling you, expressing the wish of where you want your pension to go after death. So I think it's bringing it to action. Actions now, not let's talk about you dying. It's about what can we do today to make sure your money goes to the right place at the right time with the right amount of tax off it. I think that's just getting away from death and morbidity into actual actions, an action plan.
Yeah. I think that reframing makes it less morbid, like you just said.
Yeah, nobody likes to talk about their death.
Yeah.
Or I can imagine I don't like talking about mine.
There's probably a very small percentage of people who do, but yeah.
But they'll be easy to plan with.
Yeah.
Dying, what are we going to do about your tax bill?
Yeah. What are the core fundamental elements that must exist in modern, robust IHT plan today?
That's a good question. I think the budget back in October 24 has had obviously we've been talking about, it's had a bit of a massive shift in the IHT landscape. I think that massive shift's just more and more people are going to be impacted. I don't think fundamentally it's changed the principles of IHT plan and how you get a robust IHT plan. Obviously, the first step to having a robust IHT plan is identifying if you've got any wealth that's over the tax-free amounts. Now, the tax-free amounts, the nil rate band, the residence nil rate band, so that could be up to £1 million for a couple. So the baseline of any IHT plan is identifying whether you're going to have a problem in the first place. And with pensions in your estate, average house prices in the south of England are possibly using up most of that £1 million before any other assets go in. So step one is identifying if your wealth's going to be over the nil rate bands, and then you know you've got a problem. But step two is it's not about today's problem, because today's problem isn't the problem you're dealing with. It's in 10 years' time, how much over the nil rate band am I going to be in 15 years' time? So you have to plan for a point in the future, because today's IHT problem's small. But if you don't do anything about it, tomorrow's will be bigger, and the next days will be bigger, and the next days will be bigger, assuming things grow. So that's the first thing is identifying the size of the problem, the extent of the problem. And there's really only 4 things you've always been able to do. The first one's spend more, which seems obvious. Go an extra foreign holiday a year, or go business class instead of standard class. But I don't think in reality lots of people are going to spend their way out of it. You could make magic memories taking the grandkids to Disneyland and all these sorts of things.
Yeah.
I think the 3 main financial planning ones. First one's insuring. So instead of doing something about your IHT liability to get it down, you can just take out a protection policy, a whole of life policy. I estimate my bill's going to be £500,000. You go to your protection provider, how much a month does it cost me to be covered for the rest of my life for £500,000? And go and just insure it. I call it paying your IHT in instalments as opposed to actually IHT planning. I think IHT planning is actually reducing your liability, not making arrangements for it to be paid. But that might suit some people. Yeah. And so that takes us on to basically the only options you've got now are you use a relief, like business relief or do you gift. So if you use relief, you won't reduce your estate, but you'll have things in your estate that's exempt from IHT because of business relief. You can get up to £2.5 million at 100%, maybe 50% over that. So you can use a relief. It keeps all your assets in your estate, but hopefully that relief will still exist when you die, and the assets you've got still qualify for that relief because there's special rules. So that's one of the things. That's a way to get your IHT bill down using a relief. The place we're more involved in is gifting,
right?
Giving your money away, and that could be gifting using the exemptions that are available. There's the 3,000 exemption, 3,000 a year, £250 to as many people as you want. These aren't going to make a big dent in a big IHT bill, but something's better than nothing, I guess.
Yeah.
So you've got your exemptions. Normal expenditure out of income is more valuable. That's quite complicated. If you've got excess income, if you create a pattern of giving it away, that immediately leaves your estate. So that could be good for gifting. I think that the key thing about gifting is a lot of people say to us they either want to keep control of the money, so they're not willing to give it to their family at the moment, or they might need access themselves. So that brings trusts into the equation, really, where we get involved mostly. Because if you use a trust, obviously the trustees control the money. You can be a trustee. The trustees will be there after you're gone. So you've got that element of controlling the money. And then different types of trusts allow you different levels of access depending how much access you need to your capital. But I think fundamentally there's only those four things: spend it, insure it, use it, or gift. In practice, it might be a combination of them all. But I usually say that there's basically just three things: access, control, and tax. If you don't want access to your money and you're happy for your family to have access to your money and you don't care how it gets spent, the easiest thing to do is give your money to your family and live for 7 years. Yeah. But that's not what everybody wants. So you work back from, I need some access or I want some control. Then that's where financial planning comes in and identifying the correct solution for the circumstances you're after.
Right. Unused pensions now potentially facing heavy tax rates on death with the application of IHT and income tax for some. What options should advisors be evaluating to mitigate this specific pension-driven liability?
Yeah, I think the things I just mentioned there is the four key things, and it's still the same. But added on top of that, I think is deciding what you consume for your own needs prior to death. So everybody needs to fund their retirement. A lot of people need to fund their care. And the old paradigm that you spent your pension last, I think there's that element of it. Now you have to decide what you're going to consume for your retirement stroke care needs and what you're going to leave for giving away. Because pensions have got high marginal tax on death. You've got IHT, then you've got income tax for the beneficiaries and whatever's left behind. So that's quite a high marginal rate of tax. It can be 60% plus. Whereas generally your estate only gets 40% tax. So you have to decide that balance of what you're going to consume for your retirement needs. Because at the end of the day, your legacy is a combination of the lifetime tax you pay, tax your beneficiaries pay when you die. And it's about deciding, am I going to pay lower income tax rates now to support my living or support gifting? Or leave it and have high taxes on death? It's about getting that right. I think a lot of advisors are quite keen in normal expenditure out of income. Just turn on the income for your pension that you've never needed. It should, in principle, be surplus if you didn't need it because you've got other income that you're spending. And then just giving that regularly away, that's been quite a hot topic since the budget in 2004. That's probably the IHT thing we've been asked about most.
Yeah.
Seminars and webinars and that since 2024.
And finally, what is the compounding danger of relying on out-of-date planning or taking a deal with it later approach under this strict move regime?
Yeah, I think there's a lot. I suppose compounding is a good word. If you let your estate grow without any planning, obviously your IHT bill is going to increase. The higher your IHT bill, the more you have to do about it. So there's just the straightforward arithmetic one. If you leave it to later, you'll have a bigger problem to deal with. But then I think leaving it later, there's then two attendant issues. Issue one is you've got less time to do anything. It takes 7 years for a gift to leave your estate. So the later you leave it, the more likely you are to die within the 7 years. So the longer the time passes, you're restricting the options available to reduce your IHT bill, whether that's gifting 325,000 every 7 years or making regular gifts or whatever it is. The longer you leave it, the less time you've got to do it, which means your planning might not be effective. If you're using reliefs, the reliefs normally kick in after 2 years. So if you've left it too late, you can go down the sort of high risk relief approach and hope there. But the earlier you start, the more options you've got. And the earlier you start, the smaller the problem's going to be. Because if you give money away today, the growth doesn't belong to you. It belongs to somebody else. So the growth's not in your estate. So the sooner, the better. And there's a practical other point as well. As people get older, they might lose capacity. And when you lose capacity, the ability to do any IHT planning at all is greatly, greatly reduced. You can only do really insignificant amounts. Your attorneys can't start gifting your money away and doing IHT planning. They would need to go to the Court of Protection and get authority from the court to do some IHT planning for you. So there's that element of it as well. Leaving it too late restricts your options, but also means you might not have any options, because if you lose capacity, you just might not be able to get any sort of IHT or estate planning done. I think that's the two dangers. There's a practical one of you might not be able to do any, and the other one of you get less options if you leave it too late.
Yeah. So don't leave it too late.
With all planning, the sooner you start, the more options you have. The more options you have, the more effective you're going to be in delivering what the outcome is. And there's the people aspect of it as well. If your kids are struggling with university fees or struggling with a house deposit or whatever, spending money today is an active estate planning decision. I'm going to have a greater impact in my son's life if I give him the deposit for his first flat. If I set up a trust and say he can get the money after I'm dead, sort of thing. So there's that as well. Yeah.
Yeah. Well, thank you, Les. Invaluable technical insights as always. For advisors looking to get up to speed on the technicalities of these changes, check out M&G's Tech Matters site and be sure not to miss the Trust School series of webinars, which will get you to grips with the increased demands for trust planning that have started to materialize. See how M&G, the home of retirement, provides the products, tools, and technical support you need to navigate these shifting regulations. And join us in the next episode.